Welcome to Chapter 3 of Trading Academy Book 2, Supply and Demand, where buyers and sellers control price. Every movement in the financial market begins with an imbalance between buyers and sellers. When buying pressure becomes stronger than selling pressure, price rises. When selling pressure becomes stronger than buying pressure, price falls. These areas of imbalance create what traders call demand zones and supply zones. In this chapter, you will learn how to identify these zones, understand why price reacts to them, recognize strong and weak areas, and use supply and demand to find better trading opportunities. By the end of this chapter, you will stop looking at price as random movement and begin understanding the real forces behind every move. Let's begin. Before we begin, take a moment to support our trading community. If you find these lessons valuable, please subscribe to the channel, like this video, and share it with another trader who wants to improve. Your support is the fuel that helps us create more practical lessons, clearer explanations, and valuable trading content for everyone. Every like, comment, share, and subscription motivates us to work harder and bring you better educational material. Subscribe, like, share, and let's continue growing together as traders. Now, let's begin. In this chapter, we're going to talk about supply and demand, and how to identify these important zones on the chart. This lesson is especially designed for beginners who may not yet know how to spot these levels correctly. Don't worry, I'm going to make it very simple. Let's start with a bullish demand zone. First, we see a strong, impulsive move to the upside. Then, the price pauses, takes a breath, and creates a small range or consolidation. After that, the price makes another strong move higher. So the pattern is rally, base, and rally. The base, the small range between the two impulsive moves, is extremely important. When I say important, I mean that you should mark it as a key demand level. Why? Because when the price returns to this zone, there is a high probability that it may react and move higher again. The market may attempt to mirror the previous bullish move that happened on the left side of the chart. Now, let's look at the bearish side. For a supply zone, we have the opposite pattern. First, we see a strong, impulsive move to the downside. Then, the price pauses and creates a range. After that, the price drops aggressively again. So the pattern is drop, base, and drop. That base becomes your important supply zone. When the market returns to this level, we anticipate a possible bearish reaction and another move to the downside. The price may mirror the previous bearish move that happened on the left side. Now let's identify these patterns directly on the chart. Here, we have an impulsive move to the upside. Before moving higher, the market took the low of the previous structure, removing the liquidity below it. Then, the price moved up, created a small range, and continued higher. That range now becomes an important demand zone. When the price returns to this zone, we can look for a possible reaction and continuation to the upside. For the bearish side, we use the same concept, but in the opposite direction. The price takes the liquidity above the previous high. Then, it makes an impulsive move downward, creates a range, and continues dropping. This range becomes an important supply zone. When the market returns to this area, we anticipate a possible bearish reaction and continuation to the downside. Always pay attention to the change of character on the higher time frame. Then, identify where the break of structure, or BOS, happened. Look at the area immediately before the impulsive move that created that structural break. For example, the market creates a range and then produces a powerful move downward that breaks the previous structure. That range may become your supply zone. On the bullish side, the market creates a range, followed by a powerful move upward that breaks the previous structure. That range may become your demand zone. You may also notice that the size of the next impulsive move is often similar to the previous move. For example, if the previous bullish or bearish leg moved approximately 300 pips, the next reaction may also travel a similar distance. It does not need to be exactly the same. Sometimes the market completes the full mirrored move. Other times, it may complete only 50% or slightly more. These projections can help you understand the potential reaction from a supply or demand zone. You will see this pattern repeatedly across the market. For example, a previous high is taken. The price drops impulsively, creates a range, and then continues aggressively to the downside. You may also notice a fair value gap immediately after the range. This combination can strengthen the importance of the supply zone. When the market returns to that area, it may react and continue lower. Let's look at another example. A previous high is taken. The market makes an impulsive move downward, forms a small range, and then continues dropping. That range becomes an important key level. We mark it because the price may return to this zone and mirror the previous bearish move. Now let's look at a bullish example. A previous low is taken. The market makes an impulsive move upward, creates a small range, and then produces another impulsive move higher. The small range between those two bullish movements becomes your demand zone. When the price returns to that zone, it may react and move upward again. Remember, supply and demand zones are not simply random ranges. We are looking for a range that is connected to a strong impulsive move and preferably causes a break of structure or a change in market direction. Now there is one more important point. The first touch of a supply or demand zone is usually the most important. The first time the price returns to the zone, the level may produce the strongest reaction. It is similar to a breakout and retest concept. The second touch can still create a reaction, but it may have less impact. Every time the price revisits the same zone, more orders may be consumed. Because of that, the level can gradually become weaker. So, whenever you mark a supply or demand zone, pay close attention to whether the price is returning for the first time, the second time, or has already tested the zone multiple times. To summarize, for a bullish demand zone, look for a strong move upward, a small range or base, and another strong move upward. For a bearish supply zone, look for a strong move downward, a small range or base, and another strong move downward. Focus on the range that created the impulsive movement, the break of structure, or the change of character. Then, wait for the price to return to that zone and show a clear reaction. That is supply and demand in a simple and practical way. But remember, you must practice. Open your charts, identify as many examples as possible, and observe how the price reacts when it returns to these zones. The more you practice, the easier it will become to recognize these patterns naturally. I hope this lesson was clear. Keep practicing, remain patient, and always wait for confirmation before entering a trade. Best of luck. You have now completed this lesson on supply and demand. You should have a clearer understanding of how supply and demand zones are formed, why price reacts around these areas, and how buyers and sellers influence market direction. But remember, knowledge becomes valuable only when you practice it on the chart. Review different markets, mark the zones yourself, and study how price reacts when it returns to them. Before you leave, support our trading community by liking this video, subscribing to the channel, and sharing this lesson with another trader. And leave a comment below. Tell us what you learned, what topic you want us to explain next, or which part of supply and demand you would like to understand better. Your likes, comments, shares, and subscriptions are the fuel that helps us create more valuable trading lessons and practical educational content. Like, subscribe, share, comment. Keep learning, keep practicing, and keep improving. I'll see you in the next lesson.